Hey, I am the Cardinal.
And I am the Hill in Cardinal Hill
Wealth Management.
Flows
I'm
like
Jesse
the sun.
Harris,
I'm Robert Hill, CFP
CFP.
and PhD.
I'm not a PhD.
Hey.
So if you want the
Don't feel bad.
more educated, talk to him. If you want the smarter, we'll leave that up to you.
Oh, I'm starting this one. All right, so we're going to talk to you today about a guide to considering benefits when you're changing jobs. So yeah, high level, it's exciting, it's stressful at times when you're changing jobs.
Yeah.
Depending on the context, you may have come from a layoff, you may be just switching to make more money, you may just want a better work-life balance. And a lot of times you're in negotiations, you kind of think about this stuff at a high level, but then once you decide, it can kind of feel like a whirlwind and a blur. And so we just want to give you an overview of some of the things to consider when you're changing jobs, just to make sure that you're thinking through some of the major factors. So take it away, Jeff.
All right. So when you are at your current employer, a lot of folks will have a qualified plan. We usually call them 401ks or 403bs. There can be simple IRAs, all that kind of fun stuff. Won't go into the weeds. But when you leave your current employer to switch to another employer, you have some options in what you can do with specifically those 401ks and 403bs. And the other ones have a few more rules around them, so we'll just stick high level on those. You can leave the funds where they are most of the time. So there are some plans that require you to take a distribution and roll them either to an IRA or your new plan. You can also take the check and run. So that really is what hits the three main things that you can do with the money. So you can leave it where it's at. Typically don't recommend that. The main reason being is people forget about them, or you're with Vanguard, and the Vanguard, your company that you were with, switches to Fidelity, and then it goes to a money market, and then it sits there for 10 years. And a money market, you don't get the growth of the market. You can roll over the funds to the IRA or an IRA that you get set up, and I'll go into a little bit of why you would want to do that in a minute. Or you can take a withdrawal. You can literally just take the money and run. I typically don't recommend that. Mainly because if you do take that, you're going to be required to pay taxes on the entire amount as ordinary income, unless some of it's Roth money, obviously. But you'll also most likely have to pay a 10% penalty. That's a big gotcha, and so you just got to be really careful when you do that. When you're over 59 and a half, however, that penalty will go away. There's some nuanced rules if you are over 55. You really want to look into that if you are 55 and thinking about doing that. And so that's what you can do in the withdrawal phase. But if you want to just roll it over to an IRA, there obviously are some pros to doing that. One is just, broadly speaking, there's a lot more investment asset like options in an IRA that you have the options to go into thousands and thousands of different funds, even stocks, where most 401ks won't let you do individual stocks. And they're very limited on the funds that are there. And what's great about IRAs is they're very easy to transfer. So if you're, with some other firm that's not Cardinal Hill Wealth Management and you're dissatisfied with them, it's super easy to call us and say, man, we've heard great things about you. Can you help me? And we'd love to. The other benefit of IRAs is also kind of just the distributions are a lot easier when you're coming out of an IRA, when you have to start taking those at 73 right now for RMDs. The other thing to take in consideration when you're doing a rollover is what I mentioned earlier. So you got to think about those taxes, right? So if you are taking just trad 401k or traditional 401k monies, you most likely are going to want to go to a trad IRA. And if you're taking after tax or tax-free dollars from your 401k, you're going to want to go to a Roth IRA. You just want to make sure you're managing that well, because a lot of times that paperwork gets lost and then you kind of lose some benefit if you do have some tax-free money.
Okay, and then another option if you are moving from job A to job B, let's say you're coming from IBM and going to Google, you could roll your IBM 401k potentially into your Google 401k, so you could move it to the new employer. Why would you want to do that? Well, there's some technical things I'm going to read in a second, but for some people, just simplicity, they like to consolidate their assets. They want to just keep all of their work money in one big bucket. 401ks are covered by ERISA law, which is kind of like labor, whereas IRAs, the I in the IRA is an individual. So some people like to keep all of their work money accumulating until they retire in just one vehicle, and so you can roll it over from job to job. So there are some reasons why that may be attractive. One of which is with R&D flexibility. So if you intend to work beyond age 73, participation in a qualified plan, employer's qualified plan like a 401k or a 403b, it means that you can typically delay your first R&D or required minimum distribution until the year that you retire if the plan allows it. So you can kind of defer taking those R&Ds a little bit. An exception applies if you own 5% or more of the business offering the plan. So small business owners, not as much flexibility, but if you really want to defer taking those distributions, that would be a reason to consider. Another is that typically, if creditor protection is a concern, typically 401k plans, 403bs offer a little bit better or more stringent creditor protection than IRAs. So typically employer plans can't be used to satisfy most creditors, whereas federal protection for IRA funds is more limited.
Yeah, and with that, North Carolina, where the state that we practice, is actually bumped those limits much higher in the past few years. So that is not as big a deal in North Carolina, but you do need to check your state.
Right. Okay, so we've just talked a lot about your retirement plan. That's a big consideration. Some folks are also looking at stock options, so that's another thing to consider. And so you'll want to think about, for the old job, let's say you had IBM stock options, you'd want to have a list of all of those options and when are they vesting? Are you going to forfeit anything? Some RSUs or restricted stock units allow vesting upon separation, and others don't. So you may forfeit, let's say you had a 4-year waterfall and you've worked there for a year, you may forfeit 3 years worth of that grant, or 75% of that grant, if you don't have a plan that allows vesting at separation. Others allow vesting at death, but not separation. Some allow both. So you'll want to look into that and just understand the economic impact of switching. And then similarly with your new job, you'll want to understand what stock options are allowed. You can maybe even negotiate at times. We've helped some clients say, hey, I'm going to lose all these vesting stock options. Can you sweeten the deal a little bit and make me whole? So the other thing to consider is some of these options, they have a strike price, and you may want to think about whether you exercise those options, whether they're in the money, meaning let's say you had a stock where the strike price was $100 per share and the current company was valued at $110 per share. Those would be in the money in the sense that there's value there, and so you can exercise those stock options and maybe capture the spread of that $10 of value per share. Whereas other stock options, the company may be valued at $90 a share, and so if you're not in the money, you may be wasted. It wouldn't be economical to make that decision. So you want to look into some of the nuances on that. And then also the last thing to consider is deferred compensation plan. Some employees are highly compensated employees, usually have more specific deferred compensation plans, and you'll want to look into the paperwork with those. It's hard to kind of do hand waving of those plans because they're so specific with the taxation on those, but definitely don't want to forget about that, and maybe work with a wealth manager or attorney to review kind of the tax impact of potentially forfeiting it or negotiating for a new deferred compensation plan at your new employer.
Yep. Typically on deferred comp plans, there's some at-risk money, so you just want to understand what's going on there. Life insurance and disability insurance, a lot of people do have some form of life insurance through their work, 1, 2, 3 times salary. And if you bought supplemental, these are all things that you just really want to think through when you jump jobs. So first thing that you really want to think through is, do I need it anymore? Do I need to pay the 14 cents that I'm paying for this? But the other option a lot of times is if you're maybe retiring or you are diagnosed with an illness, you a lot of times can actually keep that plan in place, and you just want to call and ask, hey, is my life insurance plan portable? If it's portable, then you just want to figure out what the premiums are going to be. You're getting a massive discount most likely because you're doing it as a company, and so the plan premium will go up. However, there are instances where it is absolutely worth continuing to pay for the premium. And disability insurance is actually a way more used insurance than life insurance. So it is just something you want to be aware of considering through your company or buying your own personal plan if it comes to that.
Absolutely. Next is health insurance, another form of really important insurance. And so typically when you leave your employer, your current health insurance ends. You typically do have the option to extend using COBRA. And so the way I think about COBRA is just the ability for you to pay more because you're paying for what the employer used to cover. So you basically have the full bill, but your coverage can continue temporarily. So obviously if you're moving to a new job, you would want to evaluate the new health plan and understand how the premiums may differ, the benefits may differ, co-payments, things like that. It's usually when you change job also what's called a qualifying event. And so let's say you work for a small company or you want to be an entrepreneur, you can typically go to the Affordable Care Act plans and shop those plans because you can typically qualify to sign up and you can evaluate that pricing. And so, yeah, it's a time to look at all of the costs and your options, but it is good to keep in mind that COBRA is typically a temporary option. So you just may be paying a little bit more for a while until you get it sorted out.
With all that said, just in summary, you want to just review every new option that you have at your job. Does it have an HSA, FSA? You just want to make sure you're really aware of their insurances, what you should do with your old 401k. Unfortunately, what I found is a lot of people put a lot of the stuff on the back burner, and they only go look into it when they need it, and at times that can be too late. And if you have a good wealth manager, then we will help you review it. So I love the opportunity to answer any questions on it. But again, my name's Jesse.
I'm Robert, Cardinal Hill Wealth Management. Please like and subscribe.